Okay, let's continue our discussion here of valuation of equity with a couple of more techniques, if you will. So, the first we want to discuss the idea that maybe dividends do not grow at a constant growth rate. And again, we had the same example when we talked about free cash flow, right? If there's some inconsistency with how you think dividends are going to grow, we need to adjust that. Now, we can do this in the simplest way, say, well, dividends change one time and then that's it. Or, as we do here in a more complicated version, we can talk about more than one change in growth. So let's see how we might be able to do this. So we have, first thing we need to do is forecast the dividends that are going to occur in this non-constant growth period. And again, we've done this several times, but once we find those dividends, we then need to find the value that we forecast at the end of this non-constant growth period. So the dividends, remember, it's D sub t equals D sub t minus 1 times 1 plus the growth rate. So we find each dividend, find the present value of each one, find the present value of the horizon value, add those together, and that is our estimated stock value for this particular stock. So here we have the growth level, 30%. Growth is 30, 25, 15, 6% thereafter. We say that the stock currently starts at $2. The required return on the investment is 13%. So we need to calculate what? The future growth. D0 times 1 plus the growth rate gives us D1. Then you take D1 times 1 plus growth gives you D2, etc. Then we have to find the value at the end of year 3. So again, the value of that in this case is $56.60. That'd be D4 times 1, the growth rate subtracted from the required return. Find the present values. That gives us $46.66. Now, we can do that much easier with a spreadsheet, of course. Here is the data we input, how many variable growth periods, weighted average cost of capital, growth after the horizon. Here is our future growth rates we're going to have. How we calculate that, again, you have to put a formula in here to calculate these future growth rates. Then you find the present value of those dividends. We need to calculate the horizon value, and we have the formula to do that. And then we also have the present value of the horizon. So it's 39.22 is the present value of this value 3 years from now. Total of $7.44 is the present value of the dividends. You add those together, that gives us our $46.66. Of course, how can we break this down? Well, we know D1 divided by the present value, that 46.66. The dividend yield on this investment is 5.6%. We know that the required return is 13%. So if you subtract the dividend yield from the total yield, total return, we end up with that 7.4% is the growth rate of this particular stock. One other thing to add, there are other ways to calculate required return. One of the ways we can use is what's referred to as your own bond yield plus some kind of risk premium adjustment. And this is your judgment, right? It's what you think it should be. So in this case, if we have a yield to maturity on this bond of 10.17%, and management gets together and says, we think that the stock should earn about 3.2% more, we can end up with this 13.37. Now, this risk premium is not the same as the capital M equity risk premium. It's just a ballpark of the required return. What we might do, though, is say find our yield to maturity, but then also let's find the yield to maturity on similar bonds and see if we can somehow look at the difference and utilize that additional risk premium. So again, it's just an additional way to calculate or think about the required return on the investment. Now, the last series of videos we'll look at here really talks about what are referred to as multipliers. So frequently use the PE ratio. We estimate the PE ratio of some companies, find the average. These are obviously comparable firms. We multiply that average PE times what we expect our company's earnings to be, and that will give us an estimate of the stock price. But before we do that, let's talk about this PE ratio. The PE ratio is typically the price divided by earnings per share. Now, if we want the forward PE, we want to know what do we think the PE ratio is going to be at the end of this year. If you take the dividend payout ratio, take what you think next year's dividend is going to be, divided by what you think next year's earnings per share are going to be, that's your dividend payout rate. Divide that by your cost of equity, or the required return on your stock, and subtract from that the growth rate of dividends. Again, what this will give us then is a PE ratio, or the forward PE ratio. If you multiply this by estimated earnings per share, that will give you an estimate of value. Companies with high growth rates, which also generate cash, right, invest higher than their needs, they're going to maintain high payout rates. So they should have high PE ratios. So companies that have lots of growth and also generate lots of cash will tend to have higher PE multipliers than other companies. So if a company has a cost of equity of 12.8, they've been paying 62% of their earnings in dividends. In addition, estimated growth rate in the company is 5.8%. This should be a ratio here, I'm sorry. But that comes out to be a forward PE ratio of 8.85. If you thought that next year your earnings per share were going to be $10, for instance, 8.85 times $10, you would predict a future price of being $88.50. Again, here's another example. This is Best Buy. The average PE ratio of comparable companies is 19.7. So we want to estimate the value using the PE valuation multiplier. If we estimate earnings per share, again, they said it's $2.22, you would estimate that the current value of this stock should be $43.73. Now, this is just one example. We can use many different kinds of multipliers. So an entity value, right? This is just the market value of equity plus the value of debt. Sometimes we refer this to as enterprise value. We can calculate this many ways, right? So what's the average entity ratio for some comparable companies? So you take the entity value and divide it by EBITDA, for instance. Now, if you multiply this by your predicted EBITDA, you would ultimately end up with a prediction of value. And that's how these multiplier models work. So the result, again, you get this total value, subtract the debt from that total value, that will give you equity. And again, as we've done earlier in videos, divide that by the number of shares, will give you a stock price. There's something referred to as the enterprise value multiplier. This is the value of the company divided by EBITDA. So how do you calculate that value? What is this number? Free cash flow divided by EBITDA divided by the difference between the weighted average cost of capital and the growth rate of free cash flow. This gives us this multiplier. Again, estimate EBITDA for next year. Multiply by that number, you'll end up with a value for the firm, not for the stock, for the whole firm. And then, of course, you work your way down through to find the number of shares. So in this case, we have the enterprise value multiplier 7.4. EBITDA is 30.7. We have 125 in cash or in debt. We have no cash. We have 5.4 in stocks. What's the value of this company? This company would end up having a value 18.922 using the enterprise value multiplier. So I think we just want to kind of end up this video, right? Let's talk a little bit about these multiplier models first. It's very hard to find comparable firms since no company is ever going to be identical. And the average ratio, it can be a very wide range. So, the average PE ratio might be 20, but the range could be from 10 to 50, right? So how do you know whether your firm should be compared to the low average or to the low, the average, or the high performers? It's a little bit difficult to use these comparable firms. How can we compare the free cash flow model to the dividend model? Well, the free cash flow model fits more situations. You can use it for privately held companies like private corporations, partnerships, sole proprietors. You can use it for divisions. You can do it for companies that don't pay dividends. Now, this free cash flow model requires some forecasted statements, though. So it takes more effort, but provides a little bit more insight into what drives the value of companies. And just the last thing, just as a reminder, we didn't talk about preferred stock earlier. Preferred stock is just, as far as valuation, it is exactly like stock valuation, except it has a growth rate of 0. So whatever formula you use for the constant growth dividend model, this is that model, except dividend has a 0 growth rate. So it's a very simple model just to transfer to the constant growth idea, because preferred stock, by definition, has a growth rate of dividends, but that dividend growth rate is 0. So I look forward to talking to you soon. Have a good day.